All right. Welcome, everybody. I'm just going to wait 1 or 2 minutes here for anyone that might be trickling in. For those of you that are here already, Happy New Year. Hope you all had great New Year's and a fantastic Christmas vacation and chance to recharge and connect with family and friends and just relax and eat a lot of good food and maybe drink a little bit of booze and have a good time. So I hope you all were able to do that. I'm feeling pretty good. We had a great Christmas. It has been quite warm this past, well, the whole month of December here in Alberta, Canada. It's been beautiful. So we spent a lot of time outside, did some snowboarding and skating and that kind of thing. So anyways, I hope you all had a great time as well, making some memories for the kiddos or whatever. But yeah, I guess we'll get started here. Anyone coming late, I will be sending you guys out, anyone that registered a recording in a couple days of this. So if you want to watch it again, or if you came in late or had you registered and ended up missing, you will get the recording. So for those of you that don't know me, I'm Cal Ewing. And as I said, I live in Calgary, Canada, but I have been investing in US real estate since 2009 is when I bought my first property down in Las Vegas. And more recently, I have shifted my focus to investing primarily in mortgage notes. Okay, so obviously that's what this webinar is about. I'm going to break down. I got a couple deals that have been on my desk just before Christmas. I'm working on closing them right now, and I thought it'd be a good opportunity to break these down for you. And these are both really small deals, but I think showing you the smaller deals can sometimes help people get more motivated because it seems more reachable. Sometimes when you're looking at deals that are a lot more money than you can afford or that you have funds available, it seems out of reach for folks. So I'm going to break down two small Iowa deals that I've got right now. So I'm just going to share my screen and then we'll dig right into this. All right. So if any of you guys have any questions, please write them down. I've got to maybe get a better webinar format because I can't see your questions right away or right directly, but write them down, send me an email. I'm happy to get back to you either with a video explaining the answer or I'll email you back an answer. But all right, so let's dive in. So this is the first performing note in Iowa. None of these are real lookers. They're not maybe houses that I would want to live in. But one of the things that I learned as a real estate investor is sometimes the house doesn't have to be something you'd want to live in order for it to be a good deal. The neighborhood doesn't have to be the neighborhood you'd choose necessarily. And sometimes the uglier houses actually make you more money. They make more sense fundamentally. So this one here, quite a bit of junk. When I first looked at it, I was a little bit hesitant, but then I realized most of this is just clutter that can be removed. The house itself doesn't look awful, and the numbers make sense, and that's all that really matters. So let's dive in. I'll show you what these numbers are. So this is a performing mortgage note, but it's actually how do I switch my, there we go. It's actually what you'd call a re-performing note because the borrower took a bit of a hiatus earlier in 2023 and stopped making their payments, but has recently got back on track again, and they've made their last 3 payments, which is good to see that they're able to keep their home and get the payments going again. Okay, so I'm looking at this as a re-performing note. And performing in the mortgage note space, if you don't know what that means, performing just means that the borrower is making their payments regularly. So if you got a home mortgage on your own house and you've been making your payments every month, you're a performing borrower, okay? Non-performing would mean that you're not making your payments. All right, so here's the numbers on this one. So the property value is around 100,000, and this is the number that Zillow supports, but I also always like to take a look at PropStream. I like to pull my own comps on a website called PropStream, and it has a pretty good way of pulling similar comparative sales in the neighborhood. And then I also typically will order what's called a broker price opinion or a realtor comparative market analysis, a realtor CMA. And what I want to do is get a realtor's opinion of value from someone that lives in that same market, knows the different neighborhoods, knows the real estate market, and can give me or you, whoever's doing the analysis of the note, give you a really good as is valuation of the property. Okay, because that's the most important thing right off the bat is we want to get an idea of what is the value of the collateral that's going to be securing our investment when we buy this mortgage note, okay? Because what we're doing, and maybe I should step back, is when you're buying a mortgage note, you are becoming the lender. So you are buying a loan or a mortgage from another lender, okay? So I could go in, if your mortgage lender, whoever that might be, if you're in the US, it might be Wells Fargo, say. If they're willing to sell it to me, I might be able to buy that mortgage from them. And now I'm your lender, and you now owe me the monthly mortgage payment instead of Wells Fargo, right? So this is the same thing. So we are actually buying the debt, and we are basically buying the borrower's promise to pay us back, is what it works out to, okay? So this property, this house here, is the collateral securing our investment. It's securing the mortgage, so that if the borrower stops paying and meeting their obligations on the mortgage, then we have the legal right, because we're the lender, we own the note. We have the right to foreclose and take the property back. Okay, we can take legal action against the borrower if they don't meet their own commitments that they agreed to. Okay, and so we need to make sure, number one, is that our investment is going to be, typically, we want it to be less than the property value. Okay, because that way, if we do have to foreclose and sell off that asset to get our money back, it's going to be worth enough to make sure we recover our investment and hopefully even make some money, make some profit in that situation. Okay, so property value here is around 100,000, and Des Moines, that whole area, there's almost all the houses around that area were over 100,000. This one did look a little bit worse for wear, but when I was looking at comps, there are other homes that sold that were in kind of dated, old, rough condition that sold for around 100, even 105, 110. Okay, so for now, 100,000 is fine. I'm good with that number, but I am waiting for a broker price opinion. So the next thing we want to look at is, what is the legal loan balance? So when we're buying the debt, we're buying this mortgage note. Well, how much does the borrower owe on it, right? Because over time, obviously, we pay down our mortgage, unless it's an interest-only loan, but most of the time it's an amortized mortgage where you're paying a little bit of the principal down every single month when you make a payment, right? So when we're buying this mortgage, it's not a brand new mortgage. So what is the amount the borrower still owes? And so that's what this is. So the borrower in this case owes $18,187. Okay, so like I said, small deal. And I was able to negotiate with the mortgage seller, the person that owned this note or the company, to buy it at a discount of $11,500. Okay, I always like to try my best to be able to buy mortgages at a discount, and I'll explain that a little bit later why that makes sense. And that's more on the foreclosure side, so that way, if we do foreclose, there's going to be a little profit there as well. Okay, so our purchase price of this note is $11,500. Now the borrower is currently paying an interest rate of 7.16%. Okay, and it was a 20-year mortgage. All right, so they got this mortgage in 2014, March of 2014, and they would pay it off if they make their payments consistently. They would be paying it off by February of 2034. So quite a bit of time left. Actually, 10 years down. So we're halfway through right now in 2024. Okay, and their monthly principal and interest payment is $210 a month. So, wow. It's not a crazy deal. It's one of those things, at least the way I approach this business, when I'm looking at buying performing or cash flowing assets like this, it's one at a time. It's taken a little bit of chunk out of my expenses, right? So if my expenses or your expenses are, say, $4,000 or $5,000 a month with groceries and your mortgage and your car payment, all of those things, if you're buying one of these, it's going to take a little bit of that debt away from you, or that those expenses. It's going to cover a little bit more of that and get you a little bit closer to freedom. And that's my goal, is to be able to have enough cash flowing notes so that if I want to take a year off and go travel, all my expenses are paid. I don't have to worry, because that money's still coming in whether I work or not. Okay, so $210 is better than nothing, right? That's going to cover, like, I don't know, power bill or something. Well, probably a little bit more than that. Okay, so those are the numbers here. Now I want to point out a couple things. So there is a lot of equity here. Okay, so just looking at what the borrower owes, let's just round it up to 20,000. So it's basically 20% loan to value. okay, on the amount that the borrower owes. So there is a lot of equity there. And to make it even better, we're buying it at about 12,000. So 12% loan to value on our investment. So this is great because if anything goes wrong and the borrower doesn't perform and we have to foreclose on this property, anyone at an auction, most of the investors that go to foreclosure auctions, they're paying way more than 20% or 12% of the property in most cases. So I can feel really confident that if we had to foreclose, it's going to be really easy to sell this off at the auction, even though it looks like this, to sell it off at the auction because it's worth 100, and it'd be really easy to get at least 18,000 back, right? So that's what I love about notes when you buy them right, is you got that security from the collateral of the value of the house. All right. Okay, so as I said, reperforming note. So let's just look at this from a performing aspect, okay? And we'll talk about the fact that he was not performing prior. So if I'm buying this note for $11,500 and I'm getting $210 a month in monthly payments, now I told you earlier that the borrower was paying 7.16% interest rate, okay? However, I'm not there. Sorry, let me rephrase this. That's on the original loan amount, 7.16% on the original amount that they borrowed on the mortgage, but I'm in for only 11.5. Okay, so let's break this down. So if I'm making $210 a month in payments, monthly payments, that's my income, and that would work out if you times that by 12 months. That's $2,520 a year. Okay. Now, if you divide that annual income by the investment amount, which was 11.5, my return is not 7.16%. My yield here, or my return on investment, is 22%. Okay. So that is awesome. And that's another reason why we like to be able to buy at a discount, because instead of earning 7.16, I'm earning 22%. Okay. And that's the power of buying mortgage notes, especially if they're not 100% performing, because you can buy them at a steeper discount. All right. So here's the payment history. This is what the note seller provided to me. So the borrower was making their payments for up until December of last year, of 2022. And then some things happened where they were having trouble. They couldn't get their payments. They had some financial difficulties, but they've been able to get back on track already, and they're starting to make their payments. Okay. Now, granted, there's going to be a little bit of work we're going to have to do here, because the actual mortgage payment is $210, and right now they are paying $200. So part of my due diligence is to figure out if that was a modification to the term, so he's allowed to pay $200, or if that's just what he can afford, and so he's been making $200,000 payments. So we're going to have to get a little bit more clearer picture about the borrower situation. But what's great here is that they are paying again. They've been paying for the last 3 months, so that's a great sign. And I would hope that they're going to keep continuing to make these payments. All right. However, what happens if they don't? What happens if they just can't seem to work things out financially where they can pay consistently? Okay. The first thing I want to try to do, I don't want to ever go into foreclosure and foreclose on the borrower, because that has some negative impacts on the borrower's credit. A foreclosure on their credit score can last for 7 years, and it can impact their credit score quite drastically. Okay. So that affects them being able to possibly buy another home someday. It affects them maybe being able to qualify for car financing if they need to buy a car. Even cell phones, sometimes they check your credit for a cell phone plan. And even some landlords will check your credit before they would lend or lease the property to you. So if they're trying to find a place to live and they have bad credit, they might not even be able to find a good place to rent, right? So I don't want to see that borrower go through that. Okay, so instead of a foreclosure, the first thing I always like to do is negotiate what's called a deed in lieu of foreclosure. Okay, and what that means, all this fancy French. So what it means really is, instead of going through the foreclosure process, you go to the seller and just say, look, let's just come to a deal here. This isn't working for you. We don't want to have to foreclose. If you just deed us the property back, we'll give you a little bit of money to get yourself moved out, cover your moving costs, maybe cover a deposit on a place to rent. and you can wipe your hands clean of this. You can move on, get back on your feet, and we'll get the deed to the property, and you're on your way. Okay. Now, sometimes when the borrower has this much equity, if they know how much equity they have, they may not go for a deed in lieu, which is understandable. But if they do, this is what it would look like. Okay, so assuming we got $100,000 property value, I'm going to assume that when we get this property back, the borrower deeds it to me. We're going to be able to sell it, let's just say at 80%. So we're going to sell it at a 20% discount just for a quick sale. Okay. So what I would do is I'd call up a local realtor and I'd say, hey, I want to sell this property as is. Can you list it at a bit of a discount so that we can get a quick, fast sale and cash out of this thing? Okay. So let's assume we sell it at 80. It's going to cost about $7,000 in sale costs when I pay my realtor their commission, pay for title insurance, and any of the other closing costs. Okay. So about $7,000 for sale costs. And then I'm going to go to the seller before we do this and say, look, Mr. Seller or Mr. Borrower, you're going to deed us this property. As soon as you move out and the house is in good order from where it is today, you're not going to pour concrete down the toilets or anything. If you can leave this house in good order, we'll give you this $5,000 to move out, right? So that's what this cash for keys is. And then our initial investment, right? 11,500. So we subtract the 80, subtract these expenses, 7,000 plus 5,000 plus 11,500. We're going to make a profit of 56,500, okay, which is 491% return. Okay, so that's if we were able to negotiate a deed in lieu of foreclosure. But what happens if the borrower does not want to go for that and we end up having to go through the full foreclosure? Well, again, if the property is worth 100,000, let's say that since we got more savvy investors that are going to the foreclosure auctions, maybe they're only going to bid up to 70% of the property value. Okay. So let's say the winning bid is 70,000. Okay. Well, that actually has no effect on us if we're selling it off at the foreclosure sale, because as the note holder, as the note investor, we're only entitled to this 18,187 that's owing on the note. Okay. And depending on how the note's written, we could also probably get our foreclosure legal fees recovered in that as well. Okay. So it doesn't matter what it sells for, as long as it sells for over 18,187, that's all we get. And the rest can be claimed by the owner, the borrower. All right. So in this case, we'd get 18,187 plus our legal costs back. And our initial investments was 11,500. So our profit's 6,687, which is kind of the same as if you did a small wholesale deal or something. So that's okay. I'm down with that. I'm cool with making just under 7,000. That's not bad, especially if I was aiming for cash flow and instead I get $7,000 in my pocket. I'm okay with that. All right. And that's a 58% return, depending on, how long the foreclosure takes and everything. If it's done in less than a year, it'd be more than that. Okay, and then the final scenario here was what happens if the borrower is like, you know what, I'm just going to pay off this mortgage right now, or I'm going to sell this house and move somewhere else, right? So they either pay us out cash, or they refinance with another lender, or they sell the house, okay? In that case, again, it's the same situation. So we're only entitled to the principal balance, the total payoff. And so the borrower, if they sell the house, they'd pay us the 187 because we own the note, and that's what's owed on the note, even though we paid 11,500, and we'd make a similar return there. Okay. So there's a bunch of different possible scenarios here that we can look at with this note, even though it's not the nicest property. It's kind of ugly. No one really, I don't want to live in Iowa. I don't know that many people that want to live in Iowa, but the numbers make sense here. Okay. So here's the first one. I'm going to go through this second one. I went pretty long on that first one, so I'm going to go through this one a little bit quicker now that I've broken down everything, and you guys can sort of see it again in a little bit faster. Okay. So here's another similar one, another performing note. Again, older property, not that great to look at, but not bad. I mean, you can see, if you can see here on the image, it seems pretty well cared for. Looks like there's a Navy veteran signs and flags in the front, so they're a veteran. They've got the grass mowed, so they're showing some pride in ownership there, even though it's an older looking home. There's a better photo for you. And this is Davenport, Indiana, or Iowa, sorry, not Indiana. I had to look up where Davenport is. I believe it's on the Mississippi River. Am I right? I'm not. I'll have to look again. It's on one of the major rivers, and the overall area had a pretty high population. I like to only invest in notes where there's a significant population around the property, because that way, if I have to hire contractors, realtors, inspectors, lawyers, whatever it is, there's going to be local people on the ground that I can rely on. Okay, so go look up Davenport and educate yourself, and I'll look it up again. So performing loan, this one, the property is worth a little bit less, but 82.6. And looking at the comparables again, that seems to be about right. All right, for other similar properties that have sold in the last year in the area. Now, in this case, the legal loan balance, so the amount the borrower owes, is $28,250, and they've been making their payments consistently for the past year. And the price I was able to negotiate with the note seller was to buy this note for $20,500. Okay, so about just under an $8,000 discount. And the borrower is currently paying, or has been paying, 8.25% interest rate on their mortgage. And this is a 30-year loan, and they originated the loan in 2010, so it's going to be paid off in 2040. All right. And their monthly payment is $255 a month, which is principal and interest. Okay, so as a performing note, this is what I'm going for. My goal right here is cash flow again. So by buying this loan for $20,500 and the monthly payment coming back to me is $255, the annual income's $3,060, which is a 15% return. So it's not bad. It's not the greatest note deal, but 15% is good. I would take a 15% return any day. All right, so again, let's say the borrower stops paying. They've been performing the whole past 12 months, so there's no sign of this, but if they were to stop paying and we negotiated that deed in lieu again to save them from a foreclosure, again, we'd sell it. Let's hope to sell it for 80% of value just for a quick sale. So let's say it sells for $66,000. There's about $5,000 in realtor fees, title insurance, and other closing costs we'd have to pay. And then we'd subtract the $5,000 that we would pay to the borrower, to move out, get them on their way, and hopefully not damage the property. So subtract that, and then subtract our initial investment. There's a profit of $35,500 here again, okay, which is 173%. And again, it depends. The return depends on how quickly we get this all done and sell the property, right? If it takes longer, then the return will be longer than a year. Okay, now what happens if we have to foreclose and sell off the property at the foreclosure auction? Well, I'm going to assume a little bit of a steeper discount just because we're dealing with possibly more savvy investors. So maybe they'll only bid up to $58,000. Again, I don't care. I have so much equity here. $28,000 is the amount owing on the mortgage. If it's sold for $58,000 at the auction, I'm easily collecting this $28,250, which is the amount the borrower owes. Okay, plus the foreclosure costs, as long as it's written that way in the note. And the initial investment is $20,500. So there's a $7,750 profit if we foreclose. And I estimated about 12 months to foreclose in Iowa. So that's a 38% return. And then lastly, if the borrower just pays us off, they decide to sell the house or something, then we would get $28,250 back. And again, same amount of profit as a foreclosure in that case. Okay. So that's how I break down these notes. These are nice little deals, easily obtainable for anyone to access, especially if you've got some money in your IRA. You can fund these types of note deals through your self-directed IRA retirement account. And what I like to do is I either will buy these notes myself with my own resources, or I actually like to partner with funding partners who might have money in their IRA that they'd like to get to work. A lot of people have lazy assets, lazy money that's sitting in investment accounts or in their retirement accounts doing nothing, like not even invested in anything. And we've all seen the amount of inflation we've seen in the last year and a bit. Our money, the value of our money is eroding away, right? If your money's doing nothing, if it's just sitting there in the bank, it's literally losing value daily. And so if your money's not doing anything, you got to put it to work earning a higher return to try and beat inflation. And you also want it to be secured to a tangible physical asset that people actually need, right? So that's why I love real estate is people are always going to need housing, shelter. It's one of our basic needs. It's not some trendy thing that's going to go out of style, right? So I like to invest in real estate because it's a physical, tangible asset. It won't go anywhere. People need it and it holds its value. And when you've got a cash flowing situation like this, or like a rental property as well, you're putting your money to work and earning a nice return. You're beating inflation and you're secured to something. So if something goes wrong, you always have the property you can sell to recover your investment. Okay. All right, so that's it for this version of our webinar. I've been trying to do these once a month, maybe twice a month. So if you like this, I'd love to hear any feedback about what you think about mortgage note investing, or even suggestions on what you'd like me to cover when we're breaking down these deals. I'm happy to dive in anywhere on any subtopics pertaining to these deals. Also, if you'd like to take part in one of these deals with me as a funding partner, where we do all the work, we find the deal, we put it together, we negotiate. I say we, but it's me and my team. But we acquire the property or acquire the note. We have a loan servicing company that handles all of the day-to-day bookkeeping and borrower communication, borrower contact. And I have real estate attorneys that I work with in every state. So if we did have to foreclose, my attorneys would handle that part of it as well. So basically, my team and I, we do all the work. You put up the funds and you get an above average return, like we were saying, as you're seeing in some of these deals. And you're secured to the property. Your name would be on the mortgage note documents, so the assignment of mortgage, the allonges, those kind of things. So that way you're always secured to the property. And then that way, if we ever have to foreclose, you're still secured to it. And we always make sure that the numbers make sense. So no matter if the borrower is paying or if we have to foreclose, there's always going to be enough there to make sure that your investment's recovered plus your profits. So if you're interested in learning a little bit more about how that works, maybe we can see if we're a fit to work together. I do have some criteria on the type of people that I'm able to work with, but I'd love to chat with you and just see what your situation is, what your investment goals are. And so feel free to book a call with me at talkwithcalewing.com. And then my other contact info is here. So if you want to just send me an email, we can do it that way. And also check out, I've got a lot of videos. I post videos weekly. So if you want to learn more about note investing or just real estate investing in general, please check out my YouTube channel and subscribe to it so you can get more content and get more educated on mortgage notes. All right, so this has been fun. I'll be sending out an email to all of you with the replay if you want to watch this again. Otherwise, please reach out to me. Send me an email if you've got questions about anything we covered here, and I'd be happy to email you back with the answer or even record a video explaining it for you and anyone else that might have the same question. Okay, guys and gals, it's been fun. Thanks for joining me. I'm Cal Ewing. Have a great rest of your day, and maybe we'll see you on the next webinar we do. Have a good one.